Welcome to another session of Business Startup Training. Today we're going to talk about depreciation. At least we're going to continue from where we left off on depreciation. So we're going to be talking about impact of depreciation on the income statement and then the statement of financial position. And we're going to also talk about Xero accounting software, and then we will also talk about tax towards the end. But I think for this session, we're just going to look at depreciation, the impact on the income statement and the statement of financial position. Let's get into it. Okay, so depreciation is a reduction in the value of an asset over time due in particular to wear and tear. So we spoke about that the last time, and we know there's a principle called provision for depreciation where you provide for or prepare for the devaluation of an asset. And we spoke about that already. Now, we need to actually reflect this information in the income statement. The income statement is one of the main statements that is used to prepare a company's financial report. And that statement actually reflects what the company makes for the period. There are two main categories that a company needs to look at. First, it needs to consider the gross profit for the period, which is the initial profit after cost of goods sold has been removed, which is normally the buying costs or the initial cost of providing the product or service. And then we have the operating costs. And in the operating costs, we would consider depreciation. Now, let's look at an example. Let's say you were to have, be fortunate to have a gross profit of 5 million. And let's look at what happens when we looked at an example earlier. We looked at an example where we considered a van that was bought for 25,000, depreciated for 5 years. Now, if that was a situation in year one, the depreciation as calculated per the example was 5,000 in year one. So 5,000 subtracted from we can actually add 5,000 to the rent, and then we'll subtract it from the 5 million in gross profit, give us 395,000 in terms of our operating profit. So 395,000 in operating profit, what we can consider here. But let's look at another situation where there's no depreciation, and let's see the impact of what profit is going to be like. So if we were to have zero depreciation, say we were to remove the depreciation or we did not calculate the depreciation. So it would have the rent, which is 1.5 million, which one subtracted from the 5 million gives us 3,500,000. So we can see here that the profit is higher when there is no depreciation, but the profit is lower when we consider depreciation. Okay, so that's the important principle there. Now, let's consider what's the impact in the statement of financial position. As we mentioned in the previous YouTube video, we said depreciation has three, in terms of the statement of financial position, there are three main categories. Some might say four, but let's talk about three. First one, we need to consider the cost of the asset, which is what we bought the asset for initially. Now, here we bought the asset for 25,000. So the initial cost of the asset is 25,000. Now, the depreciation, which we calculated in year one, is 5,000. So the net book value, which is the current value we have on our books of the asset, is 20,000. So that's important to us. Our current system appraises this asset at 20,000 after 1 year. Now, if we were to consider all 5 years altogether, we remember the initial cost of the asset is 25,000. And so the aggregate depreciation, which is all the depreciation for the 5 years, we can consider it to be 16,808. And so the net book value is 8,192. Okay, so we can reflect the idea of the two principles here. Now we have Xero accounting software. You can basically look at the principle here in Xero accounting software. Here we can consider the balance sheet, and they actually look at the fixed asset register as well. So we can compare, it's reconciled. So we actually see the actual purchase price of the asset and then the depreciation calculated to date and the difference, which gives us a net book value. That's done for computer and office equipment. There's some renovation there, but we'll not consider that. But we can actually see the same principle being demonstrated in the Xero accounting software, whereby instead of it actually being on a horizontal, they actually do it in a vertical way. So it's slightly different in that regard. But the main principle is, and they actually have the net book value at the very beginning as opposed to having the net book value at the end. So difference in style, but the main principle is capturing the value of the asset, aggregate depreciation for the period, and then the net book value. Okay, we're gonna move on to another video. So we'll stop for this particular session, but join us again for the next session where we'll consider a little bit further the impact of depreciation on the income statement and the statement of financial position. Like, share, subscribe.